Right, good morning everyone and welcome to this month's Nikko Asset Management Update. I'm Sam Bryden and I'm sitting in place of our usual host, George Carter. For those that are new to the call, it takes around an hour's time, with the first half dedicated to an international guest speaker, followed by two 15-minute slots from our local bond and equity teams. If you have any questions throughout the call, please send them through by clicking on the Q&A box at the bottom of your screen and we will try to get through as many as possible. Many of you will be familiar with Andrew Hunt, our international guest speaker today. Andrew is an economist based in the UK and has been providing insights to Nikko and our clients for many years. Andrew brings a true global economic point of view, which is always topical and thought-provoking. The title of Andrew's presentation, The Return of the Growth Inflation Trade-off, is a topic that I'm sure many of you will be interested in today. Andrew will speak for around 20 minutes, which will leave 5 minutes for questions at the end. Over to you, Andrew.
Thanks a lot, and good to be speaking to you all again. I'm going to just share my screen here. As those of you who know me, I always like to have a few charts. Hopefully, some of them sort of bordering on common sense. An interesting world. I think if we were to think about equity markets in an absolute sense, so equity markets relative or share prices relative to the consumer price index, equity market capitalization relative to GDP, or my personal favorite, which is to look at the cash multiple of the market. So the market capitalization divided by the cash returns to shareholders, either through buybacks, dividends, share option schemes. I mean, on any absolute metric that you'd like to use, global equities are expensive, US equities are particularly expensive. However, and I think this is a crucial point, compared to bonds, equity markets remain essentially cheap. The yield gap is still favorable for equities. Relative yields are reasonably supportive. Particularly when you look at the total cash disbursement to shareholders that comes from the equity markets. So equities may be expensive, bonds arguably are even more expensive. And I think if you're worried about a crack in equity markets, you first have to be worried about a severe crack in bond markets. And were that to happen, I think it would affect the equity market in a number of ways. The first one is the obvious one, the discount rate. If we're discounting future earnings, high yields obviously are a problem. Perhaps a little more subtle, high yields mean that companies will be able to afford to issue less debt to finance buybacks. So you get less funds flow into that markets, less funds flow into the equity market through that route. And more subtly still, there's what I call the collateral effect. All those leveraged fund managers that like to borrow money to speculate in stocks and other assets, they have to pledge collateral. That's been a feature of the post-GFC world. The only collateral that most lenders will accept nowadays is treasury bonds. And if the price of treasury bonds falls, then these potential leveraged investors have less collateral to offer. They can borrow less. You get much less funds flow. And that's been a very important feature of markets really in the last 12 months or so. A rising bond price, as we saw 4 or 5 weeks ago, gifts extra collateral to the leveraged fund community. They borrow more, you get more funds flow into the equity markets. The equity markets do quite well on that, but the reverse is also true. So I think it's very fair to say that actually it's all about bonds now. In a sense, we're all bond managers now. And of course, when people think about the outlook for bond markets, they think about inflation. And I suppose the main theme of this presentation is inflation a threat to bond markets? Do we need to be worried about inflation? Will it lead to high yields, lower bond prices, cause all those negative impacts I show on this slide, and feed back into the equity market? Well, first thing I would say about the bond markets is they're not actually that good at predicting inflation. The so-called bond vigilantes that are supposed to keep us all honest, or at least keep central bankers honest, are often asleep at the post. We tend to think of the 1970s as having been a decade that was incredibly bad for bondholders. A lot of wealth was destroyed, and that is true. But it's interesting that the damage occurred at the end of the decade. It wasn't the big rise in oil prices and the 15-20% rates of inflation we saw at the end of 73, early 74 that really damaged bonds. It was at the end of the decade, 77, 78, and particularly 79, 80. And that was the period where financial markets, and particularly the bond markets, had to realize that the trade-off between growth and inflation had deteriorated. The original burst of inflation back in 73, markets were prepared to believe was a bit transitory. They were prepared to look through it. Bonds sold off a bit, but not drastically, and actually rallied thereafter. It's when, in the latter part of the decade, that people found that inflation had become endemic, that it wasn't going away, and in fact, the trade-off between growth and inflation had deteriorated. That's when the real damage was done to bondholders. And at the moment, I think there's a lot of parallels in that. At the moment, just as in the early 70s, markets are choosing to believe that policymakers have this all under control. They're choosing to believe that when Jerome Powell stands up at his press conference, as he did earlier this week, and says, inflation isn't a problem, they're tending to believe him. And the markets, therefore, I think, have a rather sanguine view about inflation. And it's going to take probably quite a big shock to dispossess them of that view. Now, they may get a shock in September, October this year. And certainly I think we'll do a wobble in bonds as we start the fourth quarter. The lower panel on slide 5 looks at the implied forecast in the break-evens for inflation rates on a 3-month basis in the US for the fourth quarter. Now, we're currently annualizing at nearly 10% inflation, and yet the market is assuming that's going to drop to 2 over the next 6 weeks. I think that's a pretty unrealistic expectation. And so we're probably due some further bad news on inflation in the US and elsewhere, just because the market's expectations are so benign. And I think the outturn will be something else. Nevertheless, I still think there's a chance that markets might choose to look through it. They're being promised that inflation may fall later in the year, and there's a fair chance that it will. But that's certainly a potential stress point, as I think as we get into late August, September, and particularly towards that often awkward month of October, markets are going to have to digest further bad news on inflation, just simply because I think their expectations are much too optimistic when it comes to inflation. And why is that? I don't want to spend too long on slide 6. A bit of supply and demand for those that remember their textbooks. But I think that the central hypothesis or the central assumption that I would make is that although COVID-19 reduced the level of aggregate demand in the global economy for a period of time, only for a relatively short period of time, because of course we had a lot of policy easing. New Zealand saw a big easing in fiscal policy. We saw effectively QE, credit conditions were eased. And actually, if there was an interruption to aggregate demand, to the amount of demand in the economy, it was probably relatively temporary. Whereas when we look at the aggregate supply in the economy, that was damaged much more fundamentally, and I think has yet to recover. And in fact, that may be getting worse. And so when people talk about the loss of GDP because of the pandemic, what is essentially showing at the bottom of page 6, we don't really know whether that drop in GDP was because of a lack of demand or an inability to supply. Now, I think the markets are assuming it's a lack of demand. But then you take somewhere like New Zealand, nominal GDP, which is demand, is higher than it was pre-pandemic. And yet container ship arrivals in New Zealand are down by nearly 20%. We've got all sorts of dislocations, and that's in New Zealand, which is, of course, COVID-free. Come to the UK, and I could sort of point out the ports here are basically dysfunctional. Our local container terminal, Felix, though, essentially has been shut down by an outbreak of COVID. There's very little moving in or out at all. And that, to me, says that the disruption to supply has been much bigger than the disruption to demand. And in fact, we've got a vertical supply curve or a truncated supply curve. It doesn't matter how much you demand, the domestic economy can't produce, or in fact, the global economy can't really produce as much as you might like to to buy, particularly with the help of all those government stimuli. And there's signs of this all around. I mean, I think we're also suffering politics and bad luck as well. By politics, I mean geopolitics. It's certainly true that capital spending in North Asia is very weak. I think China's more aggressive stance has damaged capital spending, and therefore we're seeing less supply coming on stream than we might in the past, as well as, so that's on top of the effects of the pandemic. And we have a particular problem in the shipping industry. New environmental rules came in to govern the shipping industry and their emissions last year. Most of the ship owners ignored it because their ships were mothballed because of the virus. Now they're trying to come back online and discovering they're not allowed to dock in North America or Western Europe because they pollute too much. They need to have what are known as scrubbers fitted to their emission systems. And we're talking millions of dollars to do that. And it also takes time. And the global shipping industry is essentially out of compliance. That's another source of disruption on top of the pandemic. And so I think, to me, it's very clear that we've got a supply constraint in the global economy. And that's why, only a few hours ago, the US GDP data wasn't as strong in real terms as people were expecting. Interestingly, the consensus number for nominal growth was right, but the real number was wrong. It came out as inflation instead, because the supply side can't keep up. We're not seeing a big rise in global industrial production because we just can't do it. Inventory ratios have crashed, particularly in places like the United States. US small companies are saying they're shorter of inventories than they've been at any time in their entire history. Trucking volumes have fallen. I mentioned New Zealand shipping, German orders relative to production. Pretty much everything you look at says that the supply side of the world can't keep up with demand, that we've got demand pressure. And some of this problem has been made worse by the policy response. So much quantitative easing has been done by the central banks that they've actually managed to blow up the commercial banks. The commercial banks have a number of regulatory rules they have to adhere to, liquidity ratios, capital adequacy ratios. And because most of these banks have seen 10, 15, 20% growth in their assets in a short space of time, they actually haven't got enough capital. They're having problems managing their liquidity ratio. And in that environment, they have to limit the amount of risk assets they acquire. In fact, some of them are even shedding risk assets so they can be compliant. And if you're a bank shedding risk assets, the first thing you cut off is small companies, people you're not too certain of, foreign borrowers. And so we're seeing a real tightening of credit conditions in the small company sectors in the United States and many other regions around the world, which of course means they haven't got working capital. They can't afford inventories even if they could get them. And that just adds to this shortage of inventories, shortage of production, shortage of inventories. Basically, you have shortages. And that's where the price mechanism comes in. Because if you create shortages, you're gifting pricing power to companies. Also, the market system will try and ration demand according to price. And all of this, I think, is consistent with a high level of demand pressure in the global economy. Certainly, I think we have what would be described as a positive output gap in the world. Now, most analysts, and certainly the official estimates, all say we have a negative output gap because GDP is still lower than it was a year ago. But these models are based on demand models. They're not based on supply models. It's 50 years since the first oil shock when we last had a decent prolonged supply shock. And I think, was it New Zealand, you had to walk to work 2 days a week. And if you couldn't walk, you couldn't go to work. There were certainly supply constraints there. The UK, we had the power turned off for 2 or 3 days a week. And that certainly limited the production side of the economy. And very few policymakers were alive when this happened, let alone remember it. And so I think they can perhaps be forgiven for just doing the sort of Pavlovian response. Global economy is weak, throw more demand, throw more fuel into the system. But this is a seized engine because of COVID. And actually, when you throw more demand in, all you're getting is inflation and higher prices. Now, in the near term, that's been bullish for profits, but increasingly, those higher prices are starting to take their toll on people's ability to spend. And it's not just domestically that we're getting inflation. We've got global trade price inflation, the like of which we haven't seen since the late 70s. Korean export prices are rising at their fastest pace since the mid-70s. Asian export prices in general, as fast as they've pretty much ever rise in the last 25 years. US non-oil import prices. Now, this is very different to what happened after the global financial crisis. After the global financial crisis, we had falling world trade prices that dragged down inflation rates, falling import prices, offset a little bit of service sector inflation. There was no inflation despite all that QE that central banks did. On this occasion, world trade prices are inflating, most of all because we've got inflation in Asia. And although China might like to print its 1 point something inflation number each month, whether it's 1.6 in a bad month or 1.2 in a good month, in reality, that consumer price index doesn't even add up to itself. That's, we say, arithmetically challenged. And if we look at some of the less politicized measures of inflation in China, corporate goods prices up 5 or 6%, PPI up 9%, corporate price expectations as high as they've been any time since China's big inflation in 1994. China is inflating, and of course China is the provider of all of those goods that we like to buy in the warehouse or in other stores around the world. So this is a big deal. This is very different to what happened after the global financial crisis. It's and a sign that this inflation is global, that import prices are rising, and by itself this adds 150, 200 basis points to the US's rate of inflation. So we shouldn't be surprised that the US a few hours ago printed a 6% GDP inflation number. And I think that's a genuine number. We've got domestic inflation and imported inflation. But of course, as prices rise, if your wages don't keep up, it makes you poorer. So real wages in the US are falling at the moment. Real credit growth, even in China, is decelerating because of these higher prices. And I think that will probably give us some degree of an economic slowdown as we get towards the end of the year. Not a severe one, but certainly some moderation in growth. It used to be known as the Pigou effect after Professor Pigou, who was a great believer that the economy was sort of self-stabilizing. If it was weak, prices would fall, and that would make people richer in real terms, and they'd spend more, and the opposite. It never really worked in deflations, but it does tend to work a bit in inflations. So rising prices, I think, will give us a pause in growth. But what is very, very likely is that with GDP growth having disappointed this year, and then signs of a slowdown, we can assume that policymakers around the world are going to ease again. Certainly, I think that's very likely with the Biden administration, and also with China. China can't afford to slow down, certainly not for very long. It's a very, very indebted economy. Corporate sector debt is growing at the equivalent of 20-25% of GDP per year. GDP is only compounding at, let's say, 7-8% a year. This is debt trap territory. Now, the Chinese private sector in aggregate is still a net saver, only just, but the corporate sector can't really bear a slowdown. Excuse me, neither can its property markets. So there's going to be pressure on China to ease, and we've seen some signs of that already. I certainly think if the Western economies slow down towards the end of the year, there'll be more fiscal easing. But of course, if they ease and there still isn't supply, all that's going to do is bring back inflation very quickly. Now, some countries may not do this. I think New Zealand might be one of the Korea, perhaps Canada, probably aren't going to ease in response to a global slowdown, and probably end up with strong currencies as a result. In fact, they may well tighten. In fact, I think there's still room on the Kiwi rates trade. I was looking at my own measures of capacity utilization for the New Zealand economy, and I think actually the New Zealand economy is the most overheated it's been in the 40-year history of my series. So I do think the RBNZ is going to have to play catch up and tighten next year, and that probably creates a degree of strength in the Kiwi. But other countries, most notably the US and China, I suspect the UK and much of Europe, will tend to ease. They'll try and raise nominal demand, but they'll run into that supply constraint again. And this will be just, I think, a revisiting of the 1970s. So we had the big oil shock in 73. Well, we had a lot of growth before that. Then we had the inflation and the oil shock. Then we had a recession. And then policymakers, Gerald Ford, Jimmy Carter, started to ease 76, 77. We didn't get much of a rebound in the economy. So the economy here in blue, but inflation went straight back to its old peaks. And I think that's because the system was broken and also because people were expecting inflation. You may hear Chairman Powell talk a lot about inflation expectations, and he makes a strong case that inflation expectations are anchored in the US, but he's basing that on what the bond market is telling him. That's the implied inflation expectations. And I'm not sure that means very much in a world where the Federal Reserve is buying nearly $200 billion worth of bonds a month, as indeed it has over the last 4 weeks. That's not really a fair market. I think out there in the real world, and I suspect many people on this call have experienced this, is inflation is a lot higher. This lower chart on page 19 is the rate of inflation for goods that people buy every day in the United States. Now, at a headline level, it's at that 6% number already and accelerating. Modeled inflation expectations, highest we've seen since the 70s. Surveys of inflation expectations in the US, our highest we've seen since 2007, and of course the global financial crisis killed them off. If we were to look beyond that, then it's the record levels of inflation expectations in the history of this particular series. And so if you get that policy easing next year, I don't think we'll get much of a growth response. We have that vertical supply curve, but inflation will come back. And I think it's not that the inflation we're seeing at the moment will be transitory. It's that any pause in inflation over the turn of the year will turn out to be transitory. And as soon as policymakers ease, next year we'll see a sharp rise in inflation, certainly the return of inflation. And that is the moment when I think financial markets might be most at risk. Because at that point, they may have to confront the fact that the growth inflation trade-off has changed, that we're not in that same model we've had for the last 25 years, that Phillips curves are shifting up. We've seen it in a few economies already, Hong Kong, and arguably in the United States. This was the trade-off between wage inflation on the vertical axis and unemployment on the horizontal axis in the US from 2015 to 2019. There was just about a relationship there, but it was pretty benign down here in the bottom left-hand corner. Since the pandemic, it's moved up here. Now, furlough payments and all the rest of that will have affected this, but it does look like the growth inflation trade-off is changing. And if it is changing, that's not just talking about higher inflation now, it's looking at higher inflation in the future. And that's something we haven't really had to think about for the last 20 years. And that's why I think that could be quite damaging for markets. So if we do see a pause in inflation, your summer or winter, turn of the year, I think it might turn out to be quite temporary. And we're really going to have to be on our toes as we get to sort of February, March, and into the second quarter of next year. Because if policymakers ease and the result is inflation, not growth, that I think could be quite a poisonous or quite a toxic environment for financial markets. So we've got two stress periods for markets. I think there's a sort of moderate level of risk in September, October, in that inflation isn't going to come down as quickly as markets are currently predicting. And I think that's just because they're over optimistic. The maths just doesn't work out. For the rate of inflation to go from 10 to 2 in 6 weeks is just, I think, implausible without some sort of crisis, and I'm not foreseeing such a crisis. So probably some downward pressure on bond prices as we start the fourth quarter, and that may translate to some pressure on equities as well, particularly if the world's slowing at the same time, a bit of a stagflation there. If we survive that, and I suspect we will, we go into the turn of the year, a weaker economy, some moderation in inflation, but as soon as policymakers ease, I think inflation will come back. And that to me is the point where I think markets may have to wake up and worry what's going on. So I may have spoken a bit long there, but I'll try and wrap it up there in case there are any questions.
Thank you, Andrew. Yes, we do have a question that's come through. and it goes, why should we assume supply side capacity constraints will remain so restrictive by the end of 2022? Hence, any easing would contribute to inflation. How long does supply side take to reach a new equilibrium?
I think we have to work on the assumption that the pandemic is going to be with us, certainly with these new variants, for at least another year. Now, if I look at the history, the track record, as it were, of the inventory ratios and how long it takes to get production levels up, there's probably a 6-month lag, 6 to 9 months to get inventories back to normal levels, even once you've restarted production. So yeah, you've got a sort of window for the world potentially getting back to normal that would run September 2022 to the middle of 2023, based on that arithmetic. I'm a little pessimistic about the virus. I mean, at the end of the day, the vaccine rollout has stalled in a number of countries. It's difficult to see New Zealand opening up fully in the next 14 months. I'm certainly not expecting to see my house down south before 2023. Unfortunately, I'd love to, but there are doubts. In fact, I think there are genuine concerns about the effectiveness of some of the vaccines that have been used, particularly in Asia. So we've got to be at least 6 to 9 months before we get some clarity on the direction of the pandemic. Another 6 to 9 months to sort out the inventory problem. It could be 2023 before the supply side can get back to normal.
Great, thank you for that. One more question, if you can do it in several minutes. Does Andrew have a view he can share on Boris Johnson opening the UK recently?
Not one that I would like to be quoted on, and possibly not one I would convey in a family audience. Maybe that answered the question.
There we go. I think it might do. All right, thank you very much for your time, Andrew. Really appreciate you taking the time on your Thursday evening, and look forward to talking to you again soon.
Okay, that was my pleasure. Take care, guys.
Thanks, guys. Okay, so we're now going to hear from Stuart Williams, our head of domestic equities here at Nikko in New Zealand, who today is actually going to focus on the very relevant topic of ESG and how his team integrates it into their investment process. This is a topic which is increasingly asked by our clients and consultants alike, so we look forward to hearing what you have to say today, Stu. Over to you.
Hey, can you hear me okay?
Yes.
Awesome. Thanks very much. I was just struggling with the technology, so I was thinking, I was getting a lot of messages there. Okay, so in the forum today, I wanted to take a slightly different approach. Instead of talking about companies and markets and returns, I wanted to talk about our philosophy and framework around environmental, social, and governance, so ESG. I'm also going to touch a bit on SRI, given some developments in our business, and then make some general observations about ESG and SRI from our interactions with you, the people on the calls, and others like you around the industry. So there'll definitely be time for questions at the end, so queue them up. Ultimately, we're talking about this to provide you as clients or stakeholders with some information to make sure that you're informed and able to answer questions about this part of our process, how we manage your money. It's a critical part of our process, but it's not one that we talk about very often unless we are in a formal pitch or we're one-on-one. So in my view, it's important enough to carve out a separate session on this. It's also an area that's getting an incredible amount of airtime now and is likely to get more in the future. And it's an area that we're spending more time on and your companies are spending more time on. Additionally, Nikko globally is in the process of recruiting 2 ESG specialists to work alongside investment teams on ESG opportunities. So as an early frame setter as well, I would just say that it can be a slightly complicated area from the point of view that people sometimes use words interchangeably. And obviously everyone brings their own preset ideas into this. So for simplicity, I'll refer to the New Zealand Equities process during this talk, but it is consistent with the fixed interest approach and broadly consistent with the Nikko global approach as well. So Nikko New Zealand integrated ESG into our fundamental research framework in 2017. So a few headlines about what that means. So the ESG engagement is a KPI for all members of the Nikko team. That's to say that the analyst on a particular stock or security is responsible for ESG understanding and promoting that discussion, as opposed to any one person outside the team. The direction that we're taking right now is to endeavour to have meaningful engagement with all the companies that we're invested in. We achieve this by talking about the reports that I'll mention shortly from MSCI, but also by asking really open questions of the companies, because they have an information advantage on us all. It's important to ask them what they're working on, and it often throws up some interesting answers. We also log all the interactions that we have with companies on an ESG perspective to ensure that we're making adequate progress ourselves, but also the companies are making adequate progress. In the year to date, we've had 22 separate engagements with your companies on ESG issues. As a headline, sort of if I was to cut to the chase, I would say that you should be really encouraged, as we are, by the documentation and disclosure and indeed the action that your companies are taking. There's been a marked improvement in disclosure over the last few years, and it is very clear that the prioritisation of the boards and management teams is actually paying dividends across your portfolio stocks. With all that said, here's a little bit more meat on the bones about what we're up to. So Nikko New Zealand and Nikko globally is committed to sustainable investing. So we're a 2007 signatory to the UNPRI responsible investing criteria. Ferg and I are both members of the Global Steering Committee on ESG, and that's really helpful when you consider that in Europe, that their level of legislation and the heat that this topic is taking is more advanced than New Zealand. So we find it useful to hear from our Edinburgh colleagues in particular about what's happening there. I also call out my colleague Maisie Ho, who is an incredibly active participant in the ESG steering committee and recently presented to the global group on what the implications of the new modern slavery legislation in Australia means for companies in New Zealand and Australia. So there's a fair number of New Zealand companies that are caught by that, given the $100 million revenue criteria for disclosure. So a bit more on the process. So we screen all of the stocks in the portfolio and others based on or using a thing called the MSCI ESG screening tool. So that tool basically ranks all your companies from a top rating of a AAA rating to a bottom rating of a triple C, and its rating is based on global best practice as opposed to local criteria. The report's incredibly comprehensive. In many cases, for a company, it'll run 60 to 80 odd pages, and even though we think we know our companies really well, we often find interesting elements that are illuminated by this global perspective. A weak rating doesn't necessarily mean that we can't invest. It means that we need to understand more about why that rating might be less than we had expected. And indeed, a down rating doesn't also mean that we need to necessarily divest a stock. It can mean that we need to do, or will mean that we need to do more work on why that is. Now, I should say that we don't always agree in terms of why the ratings or how the ratings are calculated, that MSCI is, we need to check the data to make sure it's accurate. And so we spend a fair amount of time navigating between MSCI and the company to ensure that we're assessing correct information. And indeed, actually a nil rating, which can happen for smaller stocks, or a double B rating doesn't mean that we can't invest either. It just necessitates a high level engagement, as you'd expect, with your companies. So the process in a nutshell is to screen all the portfolios, to review the reports, and then to engage with companies. If I reflect on ESG more broadly, and this point is brought to bear from just before this, I was having a meeting with an investor relations person for one of our largest companies, and they were reminding us that they've always done the type of things that we're talking about. It just has a title of ESG right now. But anyway, the history of this for us is that we think we've always done these things really well. But just for completeness, I want to cover off for you that we always vote your shares. We cannot abstain as part of our process. You're not allowed to do that. If we do vote against a resolution, or we're contemplating voting against a resolution put up by a company, then we will write to the company to explain our rationale. We've always engaged really strongly with companies and boards directly, as opposed to just hearing from them at their annual reporting round. So through good times or bads, we've had relationships with companies. The social and environmental elements have also been covered well historically, but I would describe them as being assisted and supported by us and led by the companies themselves. And that's another way of saying that, generally speaking, New Zealand companies are doing a really good job on this in this area. It's also fair to say that from a social and an environmental element, those two aspects are really in the spotlight now. And the spotlight will mean that there's a greater government perspective. Additionally, that there will be wider social and stakeholder context that needs to be added into our engagement and indeed expectations. So with that in mind, we're really interested in what's important to you. Our ears and eyes are open to any feedback you want to provide to us about emerging themes for you as stakeholders in these companies ultimately. So to help you understand what we're up to, we will release our first active ownership report. We also now, because of the change in licensing with MSCI, can provide and disclose how the portfolio rates versus the NZX 50, any of the portfolios, how they rate against the NZX 50 using the MSCI tool, which is really interesting. Just a couple other points I'll make in the interest of clarity. So the ESG philosophy and framework is applied across all of the funds. So from the property only fund to NZ to concentrated core and to SRI. So it's not specific to one fund, it's across everything we do and into fixed interest as well. In addition to ESG, our long-running SRI fund, when I say long-running, that fund's run for about 18 years. In the SRI fund, we take the fundamental process that I've talked a little bit about in ESG, which I've talked about here, and we add specific exclusions for adult entertainment, for alcohol, for weapons, for fossil fuel extraction, and for tobacco. And the point that I would make is that there is growing relevance in this sector for the sector of investment. So funds under management in this particular area have grown to about $220 million. So it's pretty strong growth in recent times. Just a couple more points to make. If you're interested in carbon and carbon intensity, which sits in that environmental sleeve, via our relationship with MSCI now, we can present the carbon intensity of the portfolios as it relates to the index, which again is quite interesting. And then just some final comments before checking for any questions, just talk a bit about performance. So all the funds are ahead for the month to date, which is pleasing. But if you pull back and you look at the markets as opposed to the funds, then New Zealand is a bit of a laggard versus the rest of the world at the moment, with the exception of China. So I think the New Zealand market on a year-to-date basis is down 1.5% to 2%, or maybe 2.5%. China's down about 7.2%, but then you look at the rest of the world and you'll see the S&P up 17% and Europe generally up sort of 10 to 13 or 14%, and even Australia's up about 13%. So there's been a bit of an equalisation over the last couple of years. We were obviously strong in 2020 and have been weaker in 21. And just a final one, Sam, before seeing what questions there are. So just, I guess, a vaccine or a COVID comment. So I share the concerns that Andrew was talking about the speed of vaccination or lack thereof in New Zealand, and the potential vulnerability of our population if we can't get on with this. So yeah, that's not a good thing. And I guess also we're starting to understand that there will be a few issues from cohorts of our own population in terms of getting vaccinated. So I'll stop there, Sam, see if there's any questions that have come in.
Great, thanks, Stu. We do have a question or two that have come through. In your view, Stu, which company is leading the way in terms of ESG reporting, i.e. which company do you find provides the best data for you to be able to work with in terms of analysing the company on an ESG basis?
Yeah, I think somewhat unsurprisingly, Fisher & Paykel Healthcare does a really good job in this area. So everything from diversity of workforce to how they're supporting their workforce during the pandemic. The status of their leavers is important. So anyone leaving an organisation is important to understand. Their approach to sharing the profitability of the firm was also compelling. But I think you could probably look at any one of the sort of larger companies in the New Zealand market and see good disclosure. That's the most important thing, is that it's pertinent to that particular company, so that they give it the emphasis that's actually important for them, as opposed to something that an MSCI necessarily thinks is important. They're the best person to measure that.
Great. Okay. Thank you very much, Stu, for your time. We'll just pause here while you switch over with Fergus. So we are now welcoming our final speaker of today, Fergus McDonald, our Head of Bonds and Currency here at Nikko Asset Management, who many of you will be familiar with. Given Andrew Hunt's focus on growth and inflation today, and given the market here in New Zealand is pricing in a good chance of an OCR rate hike in August, we really look forward to hearing your views today, Fergus, on the timing and extent of the impending tightening cycle and the potential impact on the New Zealand bond market. Over to you, Ferg.
Thanks, Sam. Yeah, certainly that's very pertinent and what have you in our thinking. And perhaps it kind of shows up in just the returns that we've seen so far out of different segments of the bond market in New Zealand. So that bond market returns have been positive in general, but longer-term bonds have outperformed shorter-term bonds quite significantly. And that's primarily because shorter-term rates have increased, given the prospect of possible OCR increases, perhaps as early as the 18th of August, which is the next monetary policy statement from the Reserve Bank. Just give you an idea of the extent of that kind of difference in returns. The government stock index, which is the longest of our indices in New Zealand, with a duration of about 6.5 years, month to date, the government stock index is up about 1.3%, and longer dated bonds would be having a return over 2%. In contrast, the return for 1 year swap rate is minus 25 basis points, so interest rates have moved up there. 3 year swap return is minus 47. So basically the parts of the yield curve which haven't moved have been, I guess, pressured this month as those rates have just started to lift. And that's really kind of backs up our thoughts for some time that longer-term bond yields tend to peak prior to the first rate rise. And we have been patient and perhaps waiting for those rates to rise, and they probably haven't risen quite as much as we would have liked. But that pattern seems to be coming to the fore again. Our funds are currently quite neutral duration against their benchmarks. So New Zealand Bond Fund 5.5 years, Corporate Bond Fund about 3.5 years. But as I said, looking for opportunities to buy longer bonds. If they push up, if US rates push up and perhaps put a bit of pressure on our longer end, we think that's quite good buying opportunities, and I'll come on to that pretty soon. Because New Zealand's economic data has undoubtedly been strong. It's been surprising on the upside. So first quarter GDP came in at 1.6%. That was significantly above expectations of market economists. June quarter CPI likewise up 1.3% to give us 3.3% year on year, and importantly above the RBNZ's 1 to 3% target band. So on the face of it, they've got a lot of private sector economists, bank economists quite frothy about bringing forward their expectations of rate rises and almost demanding a rate rises from the RBNZ. But we don't think it's quite that kind of simple. And we continue to be of the view that both inflation and growth are transitory and will fall back again into those past trend levels, or perhaps in the area of GDP growth, probably lower than trend, unless the hard-hit areas of international tourism, international students, and unless migrant numbers perhaps bounce back, they're and recover, I guess sooner than anticipated. And the stressed areas such as kind of skilled labour shortages that are impacting the delivery or the timing of some housing, agricultural, or infrastructure projects are alleviated. We just kind of really struggle to see that the high levels of growth can just kind of continue on at those levels. And remember, for growth and inflation to maintain their current pace, which is quite high, as I just mentioned, there needs to be new impetus or catalysts for high growth. These catalysts may emerge. You can't rule that out whatsoever, because commodity markets have been strong, and perhaps they can get stronger. We know there's infrastructure projects that have been delayed, but they will inevitably come, housing and what have you. But it's difficult to kind of see exactly what's going to be the next big mover at this stage. So even though the next move in the OCR is up, undoubtedly, the OCR is not likely to move up much compared to previous cycles. So perhaps 1.5 to 2% will be the high point in our view, but perhaps as a first step, the emergency COVID easings from 1% to 0.25% may be taken back, as the economy obviously isn't in emergency state anymore, if indeed it actually ever was. But if you remember that the OCR was about 1% before all this COVID got the world in turmoil. And of course, the Delta variant has also muddied the waters when trying to predict when the RBNZ might first fire their first bullet in this tightening cycle. Many economists, as I said, have picked the 18th of August. But the outbreak in Australia, Australian lockdowns, the longer they extend and the more intensive they are, just highlights the risk associated with these outbreaks, and may just see the RBNZ, in our opinion, sit on their hands for a while longer. We think probably time's on their side. We know that the economy has been strong, and labour markets have been quite tight, but because the Reserve Bank has been talking about all of these risks, and that risk is certainly enhanced, we just think that time can continue to be on their side. But having said that, whether rates rise in August or whether it's November, whether it's early next year, we just look at the overall trend, and we don't try to put as much time into actually trying to pinpoint the precise timing of that. The trend is your friend, as the saying goes, and so we've seen that trend to higher short-term rates coming through this month. If you just talking about the RBNZ, I just picked up a little bit of information which follows on from what Stu's been talking about on the ESG side. The RBNZ is looking to add climate change to their stress testing for banks. The Assistant Governor, Simone Robbers, just recently commented saying that climate change is a direct challenge to the financial stability and therefore relates directly to the mandates of central banks. And so that's central banks around the globe, but also RBNZ. So that's just another goal. And in previous talks, I've said that the Reserve Bank is getting multiple goals, and this is just this is followed through as just another goal that they will have to try and meet. They're broken down to two things: their own balance sheet, which they go on to say stability is critical for our long-term future, talking about the RBNZ itself. And we're considering how to incorporate sustainability objectives into their own balance sheet operations. So if you remember, through all the bond buying, their balance sheet, like a lot of central banks' balance sheets, has ballooned, and they have taken primarily government bonds onto their balance sheet, New Zealand government bonds, but also LGFA and the like. But they are saying that they're mindful that any changes to our balance sheet will need to be aligned with the ability to effectively and execute our existing policy mandates, together with perhaps that financial stability mandate. So there's various things that they can do, but I would really kind of boil that down to saying that they're going to be encouraging the issuance of ESG bonds in general, and there's various ways that they can do that. But also, in their role as a regulator of banks and insurers, they're also exploring how we can incorporate climate change into our stress testing for banks and insurers. Our 2021 stress test plan includes drought conditions in a bank's stress test scenario and severe weather events and insurance scenarios. So that's kind of work in progress, but that just absolutely kind of feeds back through into the definition of risks that a company and banks and financial institutions are facing in their own balance sheets is definitely widening. So that also has some kind of rounding it back to interest rates. I think it has a few more implications as well. So if the Reserve Bank determines that risks are elevated and risks are defined far more generally, effectively where a bank has more risks, they've got to hold more capital against those risks. That has implications for returns for banks. So the more capital that's held will ultimately lead to lower returns on those assets. It also it means that more of the balance sheet will probably have to be funded by equity rather than debt, and therefore perhaps going forward, less of the bank's balance sheets will be held by debt, to be lower debt issuance. Effectively, the banks will be less highly geared, which is good from a financial stability perspective, good for New Zealand Inc., but maybe not so good for bank shareholders. Let's go one eye on the time, but also I thought I'd just mention we can't look at what the RBNZ is doing without really kind of integrating what's happening with the Fed. The Fed had one of their meetings earlier this week, came out Thursday time, and they're basically Reserve Bank. The Fed is starting to talk about reducing the massive support for the US economy. But Jerome Powell is very much keen to stress that there's still some way to go. And this is yet again, that's why our RBNZ, may well just, I think, sit on its hands a little while longer. Jerome went on to kind of say we're not there yet, and we see ourselves as having some ground to cover to get there. He said that in his press conference. And the Federal Open Market Committee is going to hold interest rates near zero. and continue to maintain the asset purchase program at 120 billion per month until substantial further progress was made on employment and inflation. So, I think that the stimulus is still going to carry on in the US for some time. The US Fed is very aware of taper tantrum problems, which, when new data is significant data is just dropped on markets, and so they are priming the market for the inevitability for some of these things to perhaps just be reduced in significance. So therefore, they don't get disruption to markets, because central banks, the Fed especially, doesn't want disruption to markets in particular. That's kind of turning very briefly to bond issuance that we've seen. Kiwi Property had a 7-year green bond issue. Bonds in general tend to be continued to be very well sought after. The ANZ is bringing a subordinated bond issue, which will be a 5+5 year. So for the first 5 years, we'll have equity credits, and that perhaps goes back to a little bit of the story that I was talking about before. And that will be having a minus credit rating compared to the ANZ senior unsecured credit rating of AA-, and we believe that should see quite broad support from both retail and wholesale markets. The Asian Development Bank had a 2026 gender bond, so an ESG bond, supporting women in business and other matters. And there's been some various other structured debt issues which have currently being talked about being brought to market as well. So with one eye on the time, I'll just perhaps leave it there and summarise that we are a little bit like the Fed, a little bit closer to reducing stimulus in the New Zealand economy. That's probably quite a right thing to do, because we do have emergency settings at the moment, but those emergency settings, when they're taken back, aren't going to be enough, I don't think, to disrupt economic settings. And mortgage rates will go up somewhat, but also because that is very much intertwined with financial stability and employment. If the economy slows too much, it is just a natural inhibitor about how far interest rates will rise. With that, I might just kind of hand it back to you, Sam, and see whether there's been any, in particular, any kind of questions which I can field.
Thanks, Fergus. Just keeping an eye on time, I think we'll finish it there. Thank you very much for your time, and thank you very much for everyone that has dialed in today. It's been great to have you with us. We will send out a recording of this call within the next day or two. If you do have any further questions for us, please just get in contact with your contact at Nikko Asset Management. Have a good rest of your Friday and a great weekend ahead. Thank you.